Welcome to the Deep Dive, the show that tries to cut through the noise and get you right to the heart of what's really important. Today, we're plunging into a topic that sounds technical, maybe, but it has huge implications. We're talking trillions of dollars here. The fascinating but often pretty disappointing world of factor investing. For years, the big promise was clear, right? Find these hidden drivers of stock returns, things like value, momentum, quality, that kind of thing, and then build these massive multi-trillion-dollar strategies around them. And it really did shape modern finance, strong academic backing, big investment firms adopting it wholesale. But here's the twist, and it's a big one. Despite all that excitement, all those sophisticated models, these widely used strategies have, well, mostly failed to deliver in the real world.
Yeah, they really have. And that's exactly why this deep dive is so important for you listening. The issue isn't just the usual suspects, things like hacking.
Which is basically finding patterns by chance,
Right.
Running tons of tests.
Exactly, or backtest overfitting, where models only look good on past data. No, the problem we're talking about today is much deeper, more insidious, really. It's a fundamental flaw baked into the standard statistical methods used in finance, a flaw that completely ignores causality.
Causality. Cause and effect.
Precisely. And this leads to what we're calling the factor mirage. It's a model that, ticks all the statistical boxes, looks great on paper, but it's fundamentally broken because it just doesn't understand the real cause and effect links in the market.
Okay, let's unpack this then. Our mission today is to figure out why this happened, expose these hidden pitfalls, and then explore a, pretty revolutionary path forward. It's called Causal Factor Investing, and it's based on some really groundbreaking research from Marcos Lopez de Prado, Alexander Lipton, and Vincent Zunichand. They're experts over at the Abu Dhabi Investment Authority. They're essentially challenging decades of standard practice here. It could really change how we think about smart investing.
It really could. It's a fundamental shift.
So let's start with the basics first. What exactly is factor investing? Can you break it down simply?
Sure. Basically, it's an investment approach that tries to profit from measurable characteristics, these factors that are supposed to explain why different stocks or bonds perform differently. Its roots go way back, seminal work like Fama and Macbeth in 1973.
Okay, so it's been around a while.
Oh, yeah. And like you said, this isn't some small niche strategy. It's massive. A multi-trillion-dollar industry. JP Morgan estimated, over $2.5 trillion managed by quant funds back in 2019.
Wow.
And BlackRock projected it would grow even more, maybe hitting $3.4 trillion by 2022, up from $1.9 trillion in 2017. So huge amounts of money are riding on these ideas.
But as you hinted, the reality has been less impressive.
That's putting it mildly. These academically blessed products have largely, quote, failed to perform as expected. The paper gives a really stark example. Take the Bloomberg Goldman Sachs Asset Management U.S. Equity Multi-Factor Index. It tracks all the big factors.
Yeah.
Momentum, value, quality, low risk.
Standard ones, yeah.
The standard ones. Its annualized Sharpe ratio from May 2007 to July 2024 was just 0.17.
Okay, hold on, Sharpe ratio. Just remind us quickly what that tells you.
Right. Good point. It's a standard measure. It basically tells you how much return you're getting for the amount of risk you're taking. Higher is generally better.
So 0.17 is?
Extremely low.
Yeah.
Especially over that long a period, like 17 years. And statistically, it's insignificant. The p-value is 0.25.
And a p-value of 0.25.
Mm-hmm.
What does that mean practically for an investor looking at this?
It means there's a 25% chance you'd get results like that purely by random luck. In finance, you really want a p-value way lower, usually below 0.05, like a 5% chance or less, to feel confident it's not just noise.
So a 1 in 4 chance is just random luck. That's not reassuring.
Not at all. And here's the real kicker, that 0.17 figure. It doesn't include any real-world costs.
Wow.
No transaction costs, no market impact from trading, no borrowing costs if you're shorting, no management fees.
So the actual return the investor sees is even worse?
Exactly. Once you factor those in, the actual total return is almost certainly negative.
That's genuinely shocking. I mean, these aren't back-of-the-envelope ideas. These are strategies peer-reviewed, published in top journals.
Right.
Yet they're underperforming so badly. It makes you think the problem isn't like sloppy work by individual researchers in the past. It points to something deeper.
That's the core argument. It suggests a fundamental flaw in the econometric canon itself, the accepted rules, the standard statistical toolkits that quants and researchers use every day.
Which brings us to the factor zoo, right? I've heard that term.
Yeah, coined by John Cochrane back in 2011. It refers to the literally thousands of factors that have been discovered over the years, many of which just don't hold up when tested out of sample. Now, the old explanation was often brute force packing, just trying millions of things until something looks significant by chance.
Data mining, basically.
Exactly, but this research suggests something more structural. It's not just about finding spurious patterns, it's about fundamentally misunderstanding the patterns you find.
And that's where this factor mirage idea comes in.
Yeah.
A model that looks statistically perfect. High R squared.
Right. R squared tells you how much of the outcome your model explains. High is good, usually.
And low p-values, suggesting significance. All the green lights are flashing. But the authors say it's structurally invalid.
Yeah, structurally invalid. It sounds bad because it is bad. It means the model's architecture, its underlying assumptions about how things connect are just wrong, even if the numbers look convincing on the surface.
So what's the core problem there?
Well, what's fascinating here is it comes down to that age-old mantra. Association does not imply causation.
We've all heard that one.
Right. But in finance, investment decisions are inherently causal acts. We don't just want to predict returns. We want to know what causes them so we can manage risk, build better portfolios. Think about the simple rooster example. The rooster crows, the sun rises, every time. The crowing perfectly predicts the sunrise. You could say it Granger causes it.
Okay, so it's a reliable predictor.
Totally reliable predictor. But does the rooster cause the sun to rise? Of course not. A controlled experiment, removing the rooster proves that easily.
Right, the sun comes up anyway.
Exactly. And that highlights the crucial difference. Predictor association is one thing, true causation is another. Our financial models need to find the actual sun, not just track the rooster. We need to identify the real drivers.
And this is where it gets really interesting, especially if you're building these models. The factor mirage doesn't just happen by accident. It comes from two specific, very common, but often ignored errors in how models are specified.
That's right. Confounder bias and collider bias.
Yeah.
They sound technical, but understanding them is key to seeing why these strategies fail. They have huge real-world impacts on your investments.
Okay, let's break them down. First one, confounder bias.
Right. So a confounder is basically a hidden variable, something that causes both the factor you're looking at, your explanatory variable, and the outcome you're interested in, like stock returns. If you fail to account for or control for this confounder in your model, your estimate of the factor's effect gets biased. You'll think your factor's doing something, but really it's this hidden confounder pulling the strings.
Okay, can you give an example?
Sure. The classic one is studying coffee drinking, let's call it X, and heart disease, Y. Now imagine smoking Z is linked to both. Maybe people who smoke also tend to drink more coffee, and smoking increases heart disease risk.
Right.
If your study on coffee and heart disease doesn't account for smoking, you might see a link between coffee and heart disease and wrongly conclude coffee is the cause.
When really it's the smoking acting as a confounder, confusing the picture.
Precisely. It confounds the relationship. Now, translate that to finance. Models with uncontrolled confounders, they're fragile, they break easily. Even if the true risk premium for your factor is stable, a shift in that unseen confounder can suddenly make your model start generating systematic losses. And it also gives a simpler explanation for something researchers often talk about: time-varying risk premia, where factors seem to pay off differently over time.
Yeah, I've heard that.
It might not be the market changing its mind about the factor. It could just be your model's estimate changing because of shifts in an unobserved confounder you didn't account for. Simpler explanation, right?
Okay, that makes sense. Fragile models due to hidden influences. What about the second pitfall? Collider bias.
Okay, collider bias. This one's trickier, maybe more counterintuitive. A collider is a variable that is caused by or is a consequence of both your factor X and your outcome, Y.
So it's an effect, not a cause.
Exactly. It's a common effect of the two things you're interested in. Now, here's the problem. Standard econometric practice often encourages you to control for colliders. Why? Because doing so often makes your model look statistically better. It can increase your R squared.
Wait, so controlling for something that improves the statistical fit actually messes things up causally? That seems backwards.
It totally is counterintuitive. But yes, controlling for a collider introduces spurious, non-causal associations between your factor and your outcome. It biases your results, often in very weird ways.
Okay, an analogy might help here.
Definitely. Think of Bergson's fallacy. Imagine a selective university admissions office. That's the collider, Z, getting admitted. Let's say they admit students who are either highly intelligent, X, or highly athletic, Y.
Okay, either way.
Right. Now, if you only look at the students who got in, you're controlling for the collider, Z, you might find a weird negative correlation between intelligence and athleticism within that group. It looks like the smart ones aren't athletic and vice versa.
But that wasn't true in the general population, only in the admitted group because of the selection criteria.
Exactly. You created a false correlation by conditioning on a common effect, the admission decision.
Wow. Okay, so the consequences of doing this in finance must be pretty bad then.
They are severe. Collider bias can literally flip the sign of your factor's estimated effect. So your model tells you to buy when you should actually sell or sell when you should buy.
That's disastrous.
It is, and worse, it makes bad models look good. It inflates the R-squared, lowers the p-values, making statistically appealing models that are actually designed to lose money.
It also enables this few-shot p-hacking you mentioned.
Yeah, because controlling for colliders quickly makes models look significant. Researchers might find these flawed models very quickly without needing to run thousands of tests. It looks like an efficient discovery, but it's finding fool's gold.
And crucially, these fake associations, they can't actually be traded on, right?
Correct. They cannot be monetized. Because the collider is an outcome, by the time you observe it, the return, the other outcome, has already happened. You can't profit from a relationship that's determined by events already in the past. You're looking backwards at a consequence, not forwards at a cause you can act on.
The paper actually showed examples of this happening in real risk models, didn't it?
Yes, very specific examples. Figure 5 in their paper shows 26 cases from well-known bar risk models. Adding a collider variable, like adding beta when trying to explain liquidity using residual volatility, or adding book to price when explaining growth using momentum, it consistently did two things.
What were they?
One, it dramatically boosted the adjusted R-squared, making the model look much better statistically. Two, it often flipped the sign of the main factor's coefficient. For instance, one model, INE2L, was looking at residual volatility's effect on liquidity. The correct causal estimate was positive, about 0.08 with a tiny r-squared. But when they added beta, a collider in this context, the coefficient flipped to negative Manica 0.036, and the r-squared jumped tenfold.
So it made a fundamentally incorrect model look statistically robust.
Exactly. It's a perfect illustration of how following the standard econometric playbook can lead you completely astray, favoring models that are structurally wrong.
Okay, so this really paints a picture of how factor investing went wrong. It wasn't necessarily bad intentions, but the standard methods themselves.
Essentially reward misspecification, especially models with colliders, because they produce those tempting high r-squareds and low p-values. It's like the system has a built-in bias towards finding these mirages. They systematically crowd out the correctly specified, truly causal models. It's a kind of self-inflicted wound for the industry.
So what about the common defenses? Like, people point to long historical backtests showing positive returns for these factors. How does this causal view explain that?
Well, the paper argues backtests are incredibly easy to overfit. You can basically torture the data until it confesses to anything. A good backtest doesn't mean your model understands the true data-generating process, the real cause and effect. It just means you fit the past well.
And what about strategies that do seem to work for a while out of sample? Sometimes they have good runs.
That could be a few things. It could just be statistical luck, a random good period, or sometimes a strategy gets popular, lots of money flows in, and that itself pushes up the prices of the assets. The strategy buys a sort of self-fulfilling prophecy.
But it's not based on a real underlying causal edge.
Right. So eventually when the flows stop or reverse, or the underlying non-causal correlation breaks down, the strategy starts to lose money. That lack of persistence is a classic sign of a non-causal model.
Okay, so this is all quite damning for the traditional approach. What's the solution then? Where do we go from here?
The solution, the paper argues, requires a fundamental shift. We need to move to causal factor investing.
Which means?
It means deliberately using the tools of causal inference before you even build the model. The goal is to first discover the causal graph.
The causal graph, like a map.
Exactly. Like a map or a wiring diagram of your variables. It shows which factors actually cause changes in other factors or in returns versus just being correlated. You need to map out the true dependencies first. There are algorithms designed to help do this, like PC or Lingam.
So you figure out the causal structure first. Then what?
Then you apply specific mathematical rules, often called do calculus. It sounds fancy, but it's a rigorous way to isolate the true causal effect of your factor, controlling for the right things, confounders, and crucially, not controlling for the wrong things, colliders.
So it's like designing a clean experiment using the data, blocking out all the misleading non-causal pathways that would normally mess up your estimates.
Precisely. It ensures your model isn't just predicting, but is actually reflecting as best as possible the true cause and effect relationships.
The authors even provide a checklist for this, right? To help people evaluate factor proposals.
They do. A best practices checklist. It covers things like, was the initial variable selection done with causality in mind? Was causal discovery performed using appropriate algorithms to find that graph? Was causal adjustment done correctly using tools like do calculus, maybe verified with software like Daggity? Yeah, it's a tool to help visualize and test the assumptions in your causal graph. The checklist also asks about causal explanatory power. Does the model genuinely explain why returns happen? And causal portfolio construction, making sure the portfolio actually captures those causal effects. And finally, it stresses using backtesting and multiple testing adjustments that are consistent with the causal findings, not just generic statistical tests.
So it's a whole new framework, really, moving beyond just saying correlation isn't causation
Yeah.
to actually doing something systematic about it in the model building process.
And this feels like a bigger shift, too, philosophically. Reconciling the purely data-driven empirical approach with the more theory-based rationalist view. I think that's right. Causal inference demands you propose a falsifiable mechanism. You can't just say the data shows this correlation. You have to propose a plausible causal story that your model then tests. It forces a deeper level of understanding, bridging data and economic reasoning.
Okay, so let's bring this home. Neglecting causality isn't just an academic issue. There are real-world costs, right? Tangible economic costs.
Absolutely. The paper highlights several. First, capital misallocation. Billions, maybe trillions, are invested based on these flawed, non-causal models. That's capital not going to be potentially more productive, economically meaningful uses. It's essentially wasted until the strategy inevitably underperforms.
Okay, what else?
Hidden leverage and risk stacking. If many popular factor strategies unknowingly rely on the same flawed assumptions, maybe they're all sensitive to the same hidden confounder, then investors who think they're diversified are actually concentrating hidden risks. They're stacking simile specification errors without realizing it.
That sounds dangerous.
It is. Then there's excessive turnover. Spurious signals from non-causal models lead investors to trade more often than necessary. All that churning racks up transaction costs, eats into returns. It's just friction burning up capital.
And the lack of persistence we talked about.
Exactly. Lack of persistence. Models built on sand, on non-causal associations, are bound to fail eventually when those associations shift, which they often do. The paper notes how shifts in collider parameters can flip estimated risk signs, explaining why factors seem to decay or change behavior unexpectedly. Causal models should be more stable.
And finally, the impact on trust.
Yeah, that's huge. Loss of trust. When live performance consistently and dramatically lags the glossy backtests, clients lose faith. They lose trust in academic finance, they lose trust in quant investing, they lose trust in their managers. That damages the entire industry's reputation.
It's really clear then, this factor mirage, born from these subtle but critical misspecifications like collider bias, is actively undermining this enormous industry. The path forward, this causal factor investing, it sounds challenging. It means, rewriting textbooks, retraining people, changing ingrained habits.
It's definitely a challenge. It requires a different way of thinking.
But the potential rewards seem massive. More stable strategies, genuinely better risk control, clearer explanations for why something works, and ultimately, more trustworthy products for the investors who rely on them.
That's the goal. More robust, reliable investment strategies grounded in a deeper understanding of market mechanics.
So wrapping up our deep dive today, the critical takeaway seems clear. If you want real investment efficiency, robust performance, you have to look beyond just statistical patterns. You need to understand the underlying causal mechanisms. It's about moving, as you said, beyond the mirage.
It really is. And maybe it leaves you, the listener, with a thought. What hidden causal links might be shaping the financial world, or even other complex systems you see every day that conventional models are currently missing? Thinking about true cause and effect, not just correlation, it's a powerful lens, not just for finance, but for understanding almost anything complex around us.
A great thought to ponder. Keep digging deep into the world around you. We'll catch you next time on The Deep Dive.